This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 3, 2026, and this is the After Hours session. Now, let's get into it. Good evening. The S&P 500 ETF, SPY, is closing in on its psychological and technical barrier at $748.89, sitting at $747.03 with a modest plus 0.72% gain. But look closer at the tape. The VIX has collapsed to 15.99, signaling deep complacency, while the Russell 2000, IWM, is the only major index in the red at minus 0.48%. Meanwhile, GameStop, GME, just dumped minus 6% on 3.6 times normal volume. The market is wide open. Before we dig into the tape, here is the schedule. Tomorrow, August 4th, brings 3 key data drops: durable goods orders, JOLTS job openings, and the trade balance. On Friday, August 5th, the ADP Employment Change Report will give us a preview of Friday's non-farm payrolls. These prints will test whether the current soft landing narrative holds water against the sticky 3.46% CPI we're seeing. Let's look at the snapshot. SPY is $747.03, up plus 0.72%. Triple Q is $687.99, up plus 0.65%. Diamonds is $524.32, up plus 0.54%. IWM is $291.20, down minus 0.48%. Sector-wise, consumer discretionary is the runaway leader at plus 3.29%, while materials, the materials sector, is lagging hard at minus 2.34%. And the headline mover, GME, crashed minus 6% on massive volume. Let's get into it.
We are seeing a bifurcation. Nominal prices are near the highs, but the internal structure is fracturing. Consumer discretionary is carrying the load while IWM bleeds. Grid, you've got the SPY resistance right at our fingertips. Walk me through the mechanics of that $750.02 ceiling.
It's a tight squeeze. SPY closed at $747.03. That puts it just 0.25% away from the July 31 high of $748.89, and effectively touching the 10-day range high of $750.02. Look at the 4-hour structure. We're compressing into a triangle apex. If we don't clear $750.02 with volume, we get a distribution phase. The immediate downside support is the July 30 close at $741.69. Break that and we slide to the 10-day low of $729.10. But here's the rub: Triple Q is diverging. Triple Q is at $687.99, well below its intraday high of $695.77. Tech is refusing to participate in this SPY breakout attempt. That's a breadth problem.
And that's where the volatility trap lies. Grid, you're looking at the chart, but I'm looking at the fear gauge. The VIX is at 15.99. It's inside the bottom of its 5-day range, which spans 15.82 to 20.88. Traders are completely unhedged. They are chasing the consumer discretionary narrative without buying put protection. That GME dump wasn't noise. It was a liquidity event. 3.6 times normal volume on a minus 6% drop means the speculative leverage is unraveling. When the mood flips, and it will flip quickly, the VIX snaps back up, and those unhedged longs in SPY get crushed into that $741.69 support level.
Hold on, let's not confuse speculative noise with fundamental flow. The GME drop is retail exit. The real money is in the consumer discretionary rotation. You're seeing a deliberate shift out of defensives and into cyclicals. Look at offshore yuan industrial, plus 10% pre-market on an earnings beat, GF score 67 over 100. That's institutional conviction. We aren't just guessing on consumer discretionary. We're seeing it supported by tangible earnings power. The question isn't whether the VIX is low, it's whether the triple Q divergence is a temporary drag or a structural breakdown.
CIPHER, you're pointing to offshore yuan as proof of strength, but remember the macro backdrop. Real GDP is slowing to 1.5%. CPI is stuck at 3.46%. How much conviction can you sustain when the yield curve is flat at plus 0.47 pp? The market is pricing in a soft landing, but the data is whispering stagnation.
Exactly, SPECTER here. We are in a classic late cycle anomaly. Equity prices are rising while the economic engine is stalling. The flat yield curve is the warning siren. You have CPI at 3.46% and core PCE at 3.29%, both far above the Fed's 2% target. Yet the Fed funds rate is at 3.63% and hasn't moved. The market is ignoring the hawkish pressure. This greed regime in the VIX is dangerous because it assumes the Fed won't react to sticky inflation. If the labor data comes in hot tomorrow, that VIX doesn't just bounce, it explodes. And with IWM down minus 0.48%, the broad economy isn't participating in this rally. It's a narrow, fragile top.
SPECTER, you're talking macro, but let's stick to the price action. The triple Q rejection at $695.77 is the technical confirmation of that fragility. If triple Q cannot reclaim that level by Tuesday, the SPY breakout is a fake out. We saw this in the 10-day range. SPY is pushing up, but the heavyweights are staying flat. The technology sector is down minus 0.22%. The healthcare sector is down minus 0.59%. This isn't a broad rally, it's a single stock phenomenon in consumer discretionary. Technically, that's unsustainable without volume expansion.
But Grid, you're missing the sector nuance. It's not that tech is weak, it's that broad tech is slow. Communication services is up plus 1.56%. Software names like ServiceNow now are up plus 3.8% ahead of earnings. This isn't a tech crash, it's a rotation into profitable growth within tech and consumer discretionary. The plus 3.29% move in consumer discretionary isn't random. It's driven by fundamentals. Offshore yuan beating estimates, software demand remaining robust. The weakness you see in the technology sector is actually capital pruning unprofitable growth names and moving into cash-flowing cyclicals. That's healthy restructuring, not a breakdown.
Healthy for whom? For the institutions exiting the meme stocks. Look at the GME volume again. 6x normal volume. That's a fire sale. Retail traders are getting stopped out. Where does that capital go? It's moving into the safer cyclicals CIPHER mentioned. So yes, the rotation is happening, but it's fueled by panic selling in the speculative sector, not genuine optimism. The VIX at 15.99 tells me nobody expects a correction. That's what gets you killed. So we have a clash. CIPHER sees fundamental support in consumer discretionary via offshore yuan and software. Pulse sees a liquidity trap with GME crashing and VIX dead flat. Grid sees a technical divergence where triple Q refuses to help SPY break $750.02. Let's drill down on the specific asset causing the stir. GameStop, GME.
GME is a pure technical collapse. It gapped down minus 6% to $20.42. The volume profile is screaming reversal. 6x average volume on a down day usually marks the end of a speculative run. There's no support level to defend here until you get back to previous consolidation zones, which are nowhere visible in the immediate term. The pattern is a breakdown. The momentum is purely negative.
And that's irrelevant to the broader market. Grid. GME is a liquidity sinkhole. Its collapse frees up margin capacity for other trades. The capital leaving GME isn't disappearing, it's reallocating. We saw it hit offshore yuan, plus 10%, and consumer discretionary constituents. The meme bubble deflating is allowing value flows to enter established businesses. Don't treat GME as a market indicator, treat it as a clearinghouse mechanism.
Clearinghouse or crack in the foundation. When you force out leveraged retail positions like GME, you create short-term volatility. But more importantly, it signals that the easy money in speculative names is gone. If traders are willing to sell GME on 6x volume without a fight, they are risk-off. That risk aversion spills over into the broader discretionary basket. If they abandon GME, what stops them from abandoning the higher beta retail stocks in consumer discretionary?
They stop when the VIX wakes up. Right now, the VIX is asleep at 15.99. Once it wakes up, it doesn't wake up gently. It spikes. And when it spikes, correlation goes to 1. Everything sells. GME, consumer discretionary, SPY, all of it. The low VIX is the biggest risk factor on this board. It gives traders a false sense of security to chase the consumer discretionary rally without protecting their downside.
Let's pivot to the broader market leader, SPY. It's at $747.03. The resistance is $748.89 and $750.02. Support is $741.69. Grid, you said earlier that if triple Q fails at $695.77, SPY fails. Is that the trigger?
Precisely, SPY is trying to lead, but it's dragging its feet. Triple Q is the beta. If triple Q cannot break $695.77, SPY is running on fumes. The divergence is widening. Today, SPY is plus 0.72% and triple Q is plus 0.65%. Tomorrow, if triple Q turns red, SPY will gap down to test $741.69 immediately. The technical setup requires triple Q to validate the move. Without triple Q, the $750.02 level is a brick wall.
Or triple Q stabilizes and SPY pushes through because the weight of the megacaps in SPY is enough to carry it. Remember, SPY includes the financials and industrials. The financial sector is essentially flat at minus 0.11%, but the energy sector is up plus 1%. Energy and industrials are contributing. SPY isn't just a tech proxy anymore. It's a diversified index. If the energy sector holds up, SPY can clear $750.02 even if triple Q chops sideways. Don't underestimate the diversification effect.
Diversification is a myth when the macro driver is broken. The energy sector is up plus 1%, sure, but that's a hedge against inflation, not a sign of growth. The 10-year two-year spread is flat at plus 0.47 pp. Real GDP is 1.5%. You're building a case for SPY to break out based on sectors that are reacting defensively to a slowing economy. That's not momentum. That's distress. If SPY clears $750.02, it will be a trap. The lack of breadth, IWM is down minus 0.48%, proves it. A true breakout requires participation from the small caps. They are absent.
So the bear case is, SPY hits $750.02, triple Q rejects, IWM lags, VIX spikes, and we fall back to $741.69. Now let's look at the counterparty. What keeps the bulls alive? CIPHER, you mentioned offshore yuan. Let's talk about the industrial rotation. Offshore yuan is plus 10%. What does that tell us about the health of the consumer discretionary thesis?
Offshore yuan is a bellwether for global infrastructure and manufacturing demand. A plus 10% move on earnings implies that corporations are still capexing. They haven't stopped investing. This supports the consumer discretionary thesis because consumer discretionary relies on a robust supply chain and consumer confidence. If offshore yuan is growing, the economy isn't collapsing, it's transitioning. The rotation from staples, consumer staples down minus 0.49%, to discretionary, consumer discretionary, up plus 3.29%, suggests consumers are still spending. This isn't a recession trade, it's a soft landing trade. As long as offshore yuan holds, the consumer discretionary rally has fundamental legs.
Fundamental legs don't matter if the chart is topping. Offshore yuan might be strong, but look at the broader the industrial sector industrials. It's only at plus 0.81%. Offshore yuan is an outlier. The sector average is lagging. This reinforces the breadth-poor diagnosis. One strong name doesn't make a trend. The trend is weak. The fact that the industrial sector is barely budging while consumer discretionary runs away suggests the rotation is shallow. Once offshore yuan profit-taking begins, the industrial sector could easily reverse, taking consumer discretionary down with it.
And that's where the sentiment turns toxic fast. Consumer discretionary is up plus 3.29%. That's euphoria territory for a single day. Usually, when a sector runs that hard in isolation, it exhausts itself. Combine that with the GME dump, and you have a market that is overly focused on one narrative. When the narrative cracks, the unwinding is violent. The VIX at 15.99 means everyone is long. Everyone is naked. The moment offshore yuan slows, or the CPI print scares the Fed, that $747.03 level becomes a magnet for short sellers.
Let's synthesize. We have a market at $747.03, testing $750.02. The technicals grid say triple Q divergence makes a breakout difficult. The fundamentals CIPHER argue that offshore yuan and software earnings provide a floor that tech alone cannot explain. But the sentiment, pulse, and risk models, SPECTER, warn that the low VIX and narrow breadth, IWM down, make any breakout suspect. SPECTER, you called out the yield curve. How does that interact with the offshore yuan strength?
It's a contradiction. Offshore yuan strength suggests industrial activity. The yield curve flatness suggests a slowdown. This is stagflation. Prices are rising, equities up, but growth is stalling, GDP 1.5%. In a stagflationary environment, the best performing assets are often those with pricing power, like the consumer discretionary names CIPHER likes. But they are vulnerable to cost-push inflation. If CPI stays at 3.46%, margins get crushed. Offshore yuan's beat today might be a one-off. Next quarter, if input costs rise and demand softens, that plus 10% disappears. The market is currently ignoring that lag effect.
That's a backward-looking view. Markets price in the future. If offshore yuan is beating, margins are holding. The market is rewarding companies that can pass on costs. That's a valid strategy. The lag effect you worry about is already priced into the valuations. SPY is high, yes, but it's high because earnings are resilient. The resilience is shown in consumer discretionary and communication services. You can't short the entire market because of a theoretical margin squeeze in Q3 when Q2 showed strength.
Resilient until $748.89. Look at the volume. SPY volume is moderate. It didn't surge on the breakout attempt. Lack of volume on an upside move is a classic distribution signal. Smart money is selling into the strength. They know triple Q is weak. They know IWM is weak. They are using the consumer discretionary noise to offload shares to the retail chasers. That is how tops form.
And the VIX confirms it. No fear premium. If smart money is selling, they aren't buying insurance. They're just exiting. The 3-6x volume in GME is the same behavior. Big players bailing out of speculative trash. The parallel is clear. The smart money is reducing risk, not increasing it. The rallies are traps. So, the consensus emerging here is caution. SPY is at a resistance wall, $750.02, with weak backing from triple Q and IWM. The rally is narrow, led by consumer discretionary and specific names like offshore yuan. The VIX is dangerously low at 15.99. Any stumble at resistance could trigger a rapid unwind to $741.69. Before we close, Apex, what is the operational takeaway for tonight?
The takeaway is respect the divergence. SPY is flirting with $750.02, but triple Q and IWM are refusing to cooperate. Grid flagged that divergence as a failure signal. CIPHER argued fundamentals support consumer discretionary, but SPECTER highlighted the macro stagnation. GDP 1.5%, flat curve. That makes that support fragile. My synthesis. The path of least resistance is a rejection at $748.89 minus $750.02. If SPY cannot close above $750.02 on expanded volume, the probability of a pullback to $741.69 increases significantly. Do not chase the consumer discretionary breakout. Wait for the triple Q to confirm or reject the move. If triple Q fails $695.77, stay on the sidelines.
And if triple Q breaks out?
Then the bullish case is validated, but you still need to watch the VIX. If VIX stays below 16 while SPY breaks out, it's a false move waiting to happen.
That wraps up this edition of ShadowQuant Equities. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.